Welcome back to our channel. Today we are going to talk about the Indian banking sector. The 12 most liquid and well capitalized stocks from the banking sector that are traded on the National Stock Exchange make up Bank Nifty. It provides a benchmark that reflects the capital market performance of the Indian banking sector to investors and market intermediaries. As per the Reserve Bank of India, India's banking sector is sufficiently capitalized and well regulated. The financial and economic conditions in the country are far superior to any other country in the world. Credit, market, and liquidity risk studies suggest that Indian banks are generally resilient and have withstood the global downturn well. A strong and efficient financial system is critical to the attainment of the objectives of creating a market-driven, productive, and competitive economy and to support higher investment levels and accentuate growth. Banking by far is the most dominant segment of the financial system and plays a vital role in the development of a sound economy. The Indian banking system has traversed a long journey to come to this phase where the health and quality of the banking system and the contribution made by it in the economic development can be comparable to the international standards. Indian banking industry has recently witnessed the rollout of innovative banking models like payments and small finance banks. RBI's new measures may go a long way in helping the restructuring of the domestic banking industry. So let's have a look at the key highlights of the sector. Bank accounts opened under Government of India Pradhan Mantri Jan Dhan Yojana are over 46.46 crore with deposits of 17,25,000 and 6.76 crore in beneficiary accounts. These values are as of 31st August 2022. Bank credit increased by 8.59% in March 2022 and deposits increased by 8.94%. Fitch estimates that armed credit growth will reach 10% in 2022-23, a double-digit increase in 8 years. India's banking sector has remained stable despite global upheavals, thereby retaining public confidence over the years. Both corporate and retail loans are in greater demand. Services, real estate, consumer durables, and related industries to agriculture have driven credit expansion. Rural India is still a major driver of digital adoption, registering an 8% year-on-year increase to 333 million internet users, which accounts to 37% of the rural population. In India, 45% of all data use occurs in rural areas. For every 10 urban internet subscribers, there are now 7 rural internet subscribers. As of August 2022, the total number of ATMs in India reached 23,08,018, out of which 47.5% are in rural and semi-urban areas. India is the second largest market for internet users and already has the second highest number of smartphone users worldwide. Over 1 billion cards are in use and 93% of digital payments will be made via mobile in 2022 thanks to the growth of neo-banking, internet banking and mobile technology. By eliminating the transaction restriction of $745 and enabling banks to establish their own limitations, the RBI has taken efforts to facilitate mobile payments, one of the primary drivers of development. In Q1 of financial year 2022, loans and advances increased by 6% year-over-year, indicating improved lending activity compared to Q1 of financial year 2021, where the pandemic was at its worst. Between 2020 and 2025, total loans and deposits are anticipated to increase at CAGRs of 8.77% and 8.48% respectively, with total loans reaching about $4 trillion and deposits reaching $3.7 trillion. Banks bolstered risk-absorbing capacity as gross non-performing assets declined to their lowest level in 6 years. Strong growth in savings amid rising disposable income levels are the major factors influencing deposit growth. According to RBI, the performance of Indian banking sector improved in financial year 2020 as lenders reported a profit on an aggregate basis after 2 years of losses. The biggest foreign lender in India is Citibank, followed by HSBC and Standard Chartered. Singapore's DBS has aggressively increased its footprint in India in recent years. The BNPL market in India is worth $3 to $3.5 billion and is expected to grow to $45 to $50 billion. by 2026 according to consultancy firm Redseed. Government data shows that digital transaction grew close to 90% from 23 lakh 2000 to over 43 lakh in 3 years from financial year 2019 to 21, primarily led by UPI. The value of digital payments in India will grow threefold to touch $1 trillion by financial year 2026 as compared to $300 billion in financial year 2021. Now let's talk about the framework of the banking sector in India. The Reserve Bank of India Act 1934, also known as the RBI Act, and the Banking Regulation Act of 1949 are the primary pieces of legislation governing the banking sector in India. The RBI Act constituted the Reserve Bank of India, which is the central bank of India and the primary regulatory authority of the banking sector. To implement regulatory policies in India, the RBI Act and the BR Act empower the RBI to issue rules, regulation, direction and guidelines on a wide range of issues relating to the banking and financial sector. Transactions related to foreign exchange, current and capital account transactions are also regulated by the RBI by virtue of the powers granted to it under the Foreign Exchange Management Act 1999. There are also other supplementary pieces of legislation regulating the banking sector, such as the Recovery of Debts Due to Banks and Financial Institutions Act 1993, the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002, the Insolvency and Bankruptcy Code 2016, and the Payment and Settlement System Act 2007. There are different categories of banks set up for different purposes. Therefore, there are various statutes and regulations made under the following statutes which govern and regulate banks. These are the RBI Act, the BR Act, FEMA Act, the Negotiation-Able Instruments Act, RDDB Act, the Bankers Book Evidence Act, the PSS Act, the SARFAESI Act, and the Integrated Ombudsman Scheme. The rules vary depending on the size and complexity of the activities as well as the structure, etc. of the banking institution. Banks in India can be broadly categorized under one of the two categories: commercial banks and cooperative banks. The commercial banks include regional rural banks and scheduled commercial banks, which are government-owned or public sector banks, private banks, branches or subsidiaries of foreign banks, and small finance banks. Scheduled commercial banks are authorized by the RBI to perform all banking functions, whereas RRBs provide credit facilities for agriculture purposes to rural areas. Cooperative banks are divided into two categories: urban cooperative banks and rural cooperative banks, which provide financing services to small borrowers in priority sectors. Now let's have a look at the SWOT analysis of the banking industry. First, we shall talk about the strengths. Despite headwinds such as increasing inflation and the Ukraine crisis, among others, India is anticipated to expand 7.3% in financial year 23, making it the world's fastest growing major economy with the capacity to absorb external shocks. Technology constitutes to be both a strength and an area for development. Strength because without it, banks could not have risen to this size and constantly expanded our market share. Balance sheet has been resilient during the pandemic and has grown further. The telesales service relationship vertical has further strengthened relationship management through increased investment in both people and technology capabilities. Digital marketing continues to make strides as a new delivery channel, creating and harnessing traffic on digital properties and contributing to direct business generation. Net NPA has been decreasing from last few quarters. The strength of the Indian BFSI sector resides in its capacity for volume delivery, as the country's size and delivery provide for a sizable consumer base. Now let's have a look at its weakness. The current items are likewise not being successfully advertised. Because of this, these banks rely mostly solely on single source of income, mainly interest income. The informal and unstructured lending and banking processes in the Indian BFSI sector are by far the sector's biggest shortcoming. In the Indian BFSI industry, for instance, crony capitalism is very much present as seen by the recent scandals involving powerful businessmen and the claims of misbehavior that have been made. This in turn raises serious concerns about its capacity to develop into a sector of the highest caliber, which is not encouraging for the nation's ambition to be a major participant and cornerstone of the world economy. Contagion risk increased in March 2022 on account of deepening interbank market linkages. Lower global growth due to slowdown in China and geopolitical tensions could have a bearing on India's export demand. Now let's discuss the threats. For the Indian BFSI sector, there are ominous clouds in the sky, particularly because of the mounting bad loans and the NPAs, which could bring down the banking industry if they are not managed in an organized way. Regarding the issue of NPAs, it is true to say that the Indian BFSI sector is going through an existential crisis. Additionally, if the sector wants to emerge as a true player on the world stage, it must go beyond its shady, wink-wink, personal collaboration, crony capitalist tactics. The Indian banking industry is currently facing a number of difficulties, including rural market segments, a lack of user education, international competition, non-performing assets, financial transaction frauds, and cyber risk. Lack of server security, insecure data storage, leakage of data on the user side, inadequate encryption. Now let's have a look at the opportunities the sector has. India will become the third largest consumer economy by 2030, driven by a young population comprising 65% population below the age of 35 years. Since most people in India do not have bank accounts, there are significant prospects for the BSFI sector, particularly in rural areas where banks and former financial sector companies are not present. The newest payment banks and other institutions that are emerging have a variety of alternatives for leveraging their current banking channels to benefit from the widespread use of mobile and smartphones. RBI has taken several steps to enable mobile payments to enhance their role in digital transactions. India's digital lending is estimated to reach $1 trillion by financial year 2023, driven by the five-fold increase in the digital disbursements. By 2025, India's fintech market is expected to reach 6.2 trillion rupees. In January 2022, Unified Payment Interface recorded 5.95 billion transactions worth rupees 10.41 trillion. Increase in working population and growing disposable incomes will raise demand for banking and related services. Housing and personal finance are expected to remain key demand drivers. Indian fintech industry is estimated to be at $150 billion by 2025. RBI announced the launch of its first global hackathon, Harbinger 2021, Innovation for Transformation, with the theme Smarter Digital Payments. Wide policy support in the form of private sector participation and liquidity infusion. Healthy regulatory oversight and credible monetary policy by the Reserve Bank of India have lent strength and stability to the country's banking sector. RBI launched the RBI Retail Direct Scheme for retail investors to increase retail participation in government securities. Rise in per capita income will lead to increase in the fraction of the Indian population that uses banking services. Population in 15 to 64 age group is expected to grow strongly going ahead, giving further push to the number of customers in the banking sector. As per Economic Survey 1819, working age population will grow by 9.7 million per year in between 2021 to 2031 and 4.2 million per year from 2031 to 2041. Now let's have a look at the sector performance in the past. As you can see in this graph, the growth in deposit has been the highest in the financial year 2022. Here is another graph comparing the growth in the bank credit. Now here is another graph comparing the income growth of the public sector, private sector and foreign banks in different financial years. In this graph we can see the interest income growth among private sector, public sector and foreign sector banks in different financial years. Now let's talk about the outlook of the banking sector. According to the management of the HDFC Bank, economic activity is poised to gain further momentum in financial year 2022-2023, supported by recovery in consumption, continued rise in exports and a push through government capital expenditure. In the Union Budget for financial year 2022-2023, The government increased its allocation on capital expenditure by 24.5% from financial year 2021 to 22 revised estimates to 7.5 lakh crore. In addition, it announced measures in the union budget such as extension of credit guarantee scheme by a year and an increase in guarantee amount and mark for the hospitality sector. This was to address the sectors worst affected by the pandemic. Recent geopolitical tensions do present some headwinds for the growth outlook. Higher crude oil prices and resulting higher fuel and transportation costs are likely to weigh on private consumption. In addition, higher input costs are likely to put stress on profit margins and could slow down the recovery in the private capex cycle. The International Monetary Fund expects the world economy to grow at a slower pace of 3.6% in 2022 from 6.1% in 2021. On balance, India's GDP growth is expected to rise by 7.3% in financial year 2022 to 2023, making it the fastest growing economy in the world. External stability related indicators like short-term debt, foreign reserves, FDI flows, etc., show that India is better positioned than the 2013 taper tantrum episode to withstand shocks. Growth, geopolitical tensions, and lingering supply side distributions are likely to weigh on domestic retail inflation as well. CPI headline inflation rose to an 8-year high of 7.8% in April 2022 versus 6.95% in March 2022, led by a broad-based increase in food prices, which rose to a 17-month high. Fuel and core inflation rose to around 8-year high of 7% in April 22. Going forward, CPI inflation is expected to average at 7.3% in first half of financial year 2023 and ease to 6.2% in second half of financial year 2023, assuming crude oil prices average at USD 105 per barrel. For the full financial year 2023, CPI inflation is expected to average at 6.7%, assuming a normal monsoon, some moderation in global commodity prices in second half, and elevated services inflation. Support from recently announced excise duty cuts on petrol and diesel is likely to be offset by some pass-through of high crude oil prices to pump prices by oil marketing companies to cover up their under-recoveries. The RBI raised its inflation forecast by 100 basis points to 6.7% for financial year 23. On the liquidity front, the central bank reiterated that it would provide enough liquidity in the system, balancing any change due to its forex operations, government spending, or seasonality, in a manner that the normalization is non-disruptive for growth. The average liquidity in the system as of May 2022 stood at INR 5.2 lakh crore. The policy rate is likely to be raised well beyond the pre-pandemic level, close to 5.75 to 6% by fiscal year end 2022-23. China's lockdown, Sri Lanka's crisis, and other geopolitical issues continue to weigh on the economic recovery, clouding India's near-term growth outlook as well. Though there are new headwinds that could cloud the economic outlook, India is better positioned, as caused by external indicators, to withstand extreme volatile episodes or shocks. Growth in the banking industry is anticipated to be further boosted by increased infrastructure spending, quick project execution, and ongoing reforms. All of these indicators point to the banking sector in India being well positioned for expansion as rapidly expanding companies seek to banks for credit. Banking sector has to make big contribution to make India a developed country by 2047. Now let's have a look at the Morgan Stanley opinion. The first leg is usually driven by expectation around better asset quality. As tail risks recede, stocks improve sharply to normalize multiples. This has already occurred over the past 2 years, it said. The second, more sustained leg is usually driven by loan growth acceleration that sets an earnings upgrade cycle, and we believe catalysts for this are falling into place. The loan growth remains strong. Margins improvement should continue in financial year 23. Management of leaders says macros are positive. Growth outlook remains strong. Sees no sign of foot being taken off the accelerator. Now let's talk about the market leaders in the Indian banking industry. If we look at the private sector banks, as per the market capitalization, HDFC Bank is leading, followed by ICICI Bank, Kotak Bank, Axis Bank, IndusInd Bank, IDBI Bank and Bandhan Bank. When it comes to public sector banks, as per the market capitalization, SBI is the leader. Now let's have a look at the index performance. Here is the year-to-date comparison with Nifty. And in the next chart, you can see the 5-year comparison with Nifty. Here is the Nifty and Bank Nifty comparison from 2001 till date. Now let's have a look at the valuation of some private sector banks. Here you can see the price to earning ratios of different private sector banks. And in this graph, you can see price to book value of different private sector banks. Moving on to the valuations of the public sector banks. In this graph, you can clearly see the price to earning ratios of different public sector banks. And in this last graph, you can see the price to book value of different public sector banks. So that's all for today. We hope you like our video. If you're new to this channel, please do subscribe and hit the bell icon. And don't forget to like and share this video. Thank you so much for watching.